The markets closed on a Friday afternoon, and the final number on the screen read $71.91. To most observers, that number feels expensive. It feels like a peak. It feels like the moment just before everything collapses. But what if your perception is the problem? What if the ruler you're using to measure value has been shrinking for 45 years and you never noticed? This is not a story about a commodity getting expensive. This is a story about a currency getting cheap. And understanding the difference may be the most important financial distinction of your lifetime. To understand where we are, we have to understand where we came from. In January of 1980, silver touched $50 an ounce. Three brothers from Texas, the Hunts, had accumulated over 100 million ounces of physical silver and hundreds of millions more in paper contracts. Their buying pressure created a feedback loop. The public rushed into coin shops. Taxi drivers traded futures. The price went parabolic. And then it collapsed. The government changed the rules. The exchanges raised margin requirements. The Federal Reserve pushed interest rates to 20%. The Hunts were forced to liquidate. Silver crashed from $50 to $10 in a matter of months. It destroyed fortunes. It created a psychological scar in the market that lasted for 2 generations. For 45 years, $50 became the ceiling that silver could never break. Every rally was met with the same refrain. Remember 1980. Remember the crash. But here's the critical data point that the history books leave out. The $50 of 1980 is not the same as $50 today. Money is a measuring stick, but the stick changes length every year due to inflation. In 1980, $50 could buy a week's worth of groceries for a family of 4. It could fill your gas tank 5 times. It could buy a decent suit. Today, $50 buys you a tank of gas maybe, and a modest dinner for one. According to the Bureau of Labor Statistics, $1 in 1980 has the same purchasing power as roughly $3.50 today. That is the official number, using their own metrics. So to find the real inflation-adjusted all-time high of silver, we have to multiply the 1980 peak by 3.5. 50 times 3.5 equals 175. At $71, silver is not at an all-time high. It is trading at a 60% discount to its 1980 purchasing power. If any other asset class were trading at 60% below its historical valuation, institutional capital would be flooding in. But because it is silver, and because of the trauma of the past, people are scared. They see a number rising and they assume it must fall. This is what economists call nominal illusion. The brain sees the nominal price and thinks expensive. It fails to see that the real price, measured in purchasing power, is historically cheap. The structural differences between 1980 and today are so profound that the Hunt brothers would not recognize this market. Let us begin with population. In 1980, the world had 4.4 billion people. Today, we have over 8 billion. The population has nearly doubled. That is double the number of consumers, double the number of people who need phones, electronics, vehicles, and energy infrastructure. Has silver supply doubled to match? No. Global mine production has plateaued over the last decade. We are extracting roughly the same amount of silver today as we were 10 years ago. Per capita, there is half as much silver available for every human being on Earth compared to the last major peak. Now consider what those people are doing with that silver. In 1980, the primary industrial use for silver was photography. It was a chemical process. Film contained silver. Labs developed the film, and crucially, photography was price elastic. If silver became expensive, Kodak raised prices, people took fewer pictures, and demand dropped. Furthermore, the silver was recyclable. The developing fluids were rich with metal that could be recovered and sold back into the market. High prices killed demand and increased supply. That is how commodity markets are supposed to work. Now look at 2025. Silver's primary industrial uses are solar panels, electric vehicles, semiconductors, 5G infrastructure, and artificial intelligence data centers. These industries are fundamentally different from photography. First, they are price inelastic. The amount of silver in a solar panel is essential for the panel to function, but it represents a small fraction of the total manufacturing cost. If silver triples from $70 to $210, the cost of silver in an iPhone goes from 50 cents to $1.50. Apple does not notice, the consumer does not notice. Production continues. Unlike the photographer in 1980 who stopped taking pictures when film got expensive, the solar industry in 2025 will not stop buying silver. They cannot. Governments have mandated it. Climate agreements require it. The alternative is going out of business. Second, and perhaps more importantly, modern silver use is consumptive. It destroys the metal. In 1980, when the price spiked, people rushed to scrapyards with their silverware. They melted down Grandma's tea set. There was a massive reservoir of above-ground stock that could be mobilized to cap the price. That reservoir no longer exists. We spent 4 decades melting it down and embedding it in electronics in quantities so small that recovery is thermodynamically impossible. You cannot economically extract the silver from an iPhone. The inventory overhang that crushed the Hunt brothers has been eaten. So we have a market with inelastic demand that cannot stop buying, and a supply chain that has no recycling release valve. The nature of the buying has also changed. The 1980 rally was driven by leverage. The Hunts were purchasing futures contracts on margin. They were borrowing money to buy silver. When the Federal Reserve raised rates to 20%, the cost of that borrowing became unsustainable. The banks called in the loans. The Hunts went bankrupt. It was a financial squeeze, vulnerable to financial countermeasures. The rally we are witnessing today is driven by shortage. The buyers are not speculators on margin. They are central banks. They are sovereign wealth funds. They are industrial manufacturers like Samsung and Tesla. They are paying cash. They are taking physical delivery. You cannot margin call a solar panel factory that has paid cash for its silver paste. You cannot force China to sell its strategic reserve. This makes the current price floor remarkably solid. In 1980, the price was a spike on a chart, unsupported by physical reality. Today, the price is a reflection of a structural deficit that has been building for 5 consecutive years. Billions of ounces have been drawn down from the vaults. The vertigo investors feel is an illusion. It is like standing on the ground floor of a skyscraper and thinking you are on the roof. Now consider the monetary base. In 1980, the M2 money supply, the total amount of cash and checking deposits in the American financial system, was roughly $1.5 trillion. Today, M2 exceeds $21 trillion. The supply of dollars has increased by a factor of 14. Has the supply of silver increased by 14 times? No. If silver had simply maintained its ratio to the number of dollars in existence, the price would be well over $300 an ounce. The fact that it trades at 71 is a testament to how heavily it has been suppressed through paper markets and derivative instruments. But those suppression mechanisms are failing. The paper-to-physical ratio on the commodities exchanges is estimated at hundreds to 1. For every ounce of physical silver in the vault, there are hundreds of ounces of paper claims. In a stable market, this functions because most participants settle in cash. They never want the metal. But in a shortage, when physical delivery becomes scarce, participants stop wanting cash. They want the metal. If even 5% of paper holders stand for delivery, the exchange cannot fulfill the obligations. They would have to declare force majeure and settle in cash at an arbitrary price. This would break the pricing mechanism entirely. We are already seeing early evidence of this divergence. The spot price reads $71.91. But walk into a coin dealer and attempt to purchase physical metal at that price. You will pay $85 or $90. The street price is already significantly higher than the paper price. The real price is screaming shortage. The gold to silver ratio is the most reliable clock in the precious metals market. Right now, gold trades at approximately $4,479. Silver at $71.91. The ratio is roughly 62 to 1. It takes 62 ounces of silver to purchase 1 ounce of gold. In nature, the ratio is approximately 8 to 1. For thousands of years under the bimetallic standard, the monetary ratio was fixed at 15 to 1. In 1980, at the peak of the mania, it compressed to 17 to 1. In 2011, it reached 30 to 1. If the ratio merely returned to the 2011 level of 30 to 1 and gold stayed exactly where it is today, silver would have to reach $150 per ounce. If it returned to the 1980 ratio of 17 to 1, silver would reach $263. And gold is not standing still. Gold is breaking to all-time highs. Silver historically acts as a leveraged play on gold. When gold rises 1%, silver often rises 2% or more. This is the catch-up trade that occurs in every precious metals cycle. The coiled spring is being released. The geopolitical landscape has shifted in ways that make Western financial countermeasures far less effective than they were in 1980. In 1980, the United States was the undisputed hegemon of the Western world. The Cold War was a binary conflict. China was an agrarian economy with almost no industrial footprint. Washington and Wall Street controlled the entire financial board. They changed the rules of the exchanges. They pressured the banks. They raised rates to kill inflation. They had the power to force the price down because they controlled every lever. Today, the board has changed. China is now the world's factory. They consume the vast majority of industrial silver. India is the world's stacker, consuming the majority of jewelry and investment silver. Mexico and Peru control the mines and are becoming increasingly independent in their resource policies. Washington and Wall Street have lost their kill switch. If the commodities exchange raises margin requirements, it does not stop a solar manufacturer in Shanghai from buying metal. It does not stop a billionaire in Mumbai from importing tonnage. The pricing power has migrated from west to east, and the east has different motivations. China is not buying silver to flip for a profit in dollars. They are buying it to construct an energy grid independent of Western oil. They are buying it to back trade settlements independent of the dollar system. Russia, India, and Brazil are accumulating gold and silver to back their currencies and settle trade imbalances. This is a quiet return to hard money. If the world moves back to a system where trade deficits are settled in metal rather than debt, the demand for silver as a monetary asset returns with force. For 40 years, silver was demonetized. It was treated as a purely industrial commodity. But if central banks begin accumulating it, if it becomes money again in the eyes of sovereign powers, the demand curve goes vertical. This geopolitical bid is the variable that was absent in 2011. It was barely present in 1980. It is unique to 2025. There is another threat emerging that will amplify silver's role as a monetary asset. Central bank digital currencies. Governments around the world are rolling out programmable money. These are not decentralized cryptocurrencies. They are surveillance instruments. Every transaction can be tracked, taxed, and controlled. The government could theoretically limit what you purchase or turn off your access entirely. Silver is the antidote is off-grid wealth. It has no serial number. It requires no electricity. It leaves no digital footprint. A transaction in physical silver is peer-to-peer, final, and private. As digital currency rollouts accelerate, the demand for non-traceable assets will surge. People will realize that their bank account is not their money. It is a ledger entry controlled by the state. Their silver is their money. This creates a privacy premium on physical metal that will widen as the digital infrastructure tightens. We may see a world where the official price reads $70, but the street price for untraceable metal is double that. So what is the endgame? How does an investor know when the cycle has peaked? The answer is ratios, not nominal prices. You do not exit when silver reaches $100. You do not exit when it reaches $200. You exit when the gold-to-silver ratio tells you that silver has become expensive relative to gold. When the ratio compresses to 40-1, you pay attention. You are approaching fair value. When it reaches 30-1, you begin swapping. You convert a portion of your silver into gold, locking in purchasing power. If it ever reaches 15-1, the historical extreme, that is the signal to exit entirely. At that point, you convert to land, to business equity, to gold. You move from speculation to preservation. By trading the ratio, you bypass the dollar completely. You do not care if the currency collapses. You are simply exchanging one form of metal for another, increasing your total weight without spending a single unit of fiat. This is how generational wealth is protected. Not by chasing dollar profits, but by accumulating real assets during periods of monetary disorder. Every structural factor points in the same direction. Inflation adjustment shows silver at a 60% discount to 1980. Population has doubled while supply has stagnated. Industrial demand is inelastic and consumptive. Recycling capacity has collapsed. The monetary base has expanded 14-fold. Geopolitical buyers are accumulating for strategic, not speculative reasons. Paper markets are strained past their structural limits. The 1980 spike was a speculative event driven by leveraged traders who could be margin called into oblivion. The 2025 rally is a structural repricing driven by entities who pay cash and take delivery, entities who cannot be forced to sell. Necessity is a stronger force than speculation. In the end, this is not about silver going up or down on any given day. It is about understanding that the measuring stick itself is shrinking. Every year the dollar buys less. Every year the debt compounds. Every year the mines deplete. The price on the screen is not the price of silver rising. It is the price of fiat currency falling, revealed through a metal that cannot be printed. Some will look at $71 and see an expensive asset near its peak. Others will look at $71 and see a strategic material trading at a fraction of its real value, in a world that needs it more than ever before. The difference between those two perspectives is not intelligence, it is calibration. And calibration, in the end, is what separates those who preserve wealth from those who watch it erode.